So good afternoon students and welcome to Understanding Profit and Loss Account Statement, that is a part of Managing Financial Operations. Now in this particular lecture or a video, there are certain objectives. The first objective of this session will be that we would try to understand the meaning of profit and loss statement. That is, what is a profit and loss statement? And along with that, we will also try to understand that what are the various accounting concepts which are related to measurement of income. That is, when we calculate or when we prepare a profit and loss account statement, then at that time, what are the various accounting concepts which we should keep in our mind? So, let us first understand what is a profit and loss statement. Now, every organization, business organization, is working with one objective of earning profits. And at the particular time, it is very important to calculate to find out that whether you have earned, the business has earned profits or losses. So for that purpose, a statement is prepared which is called as profit and loss statement. Now this profit and loss statement, it shows the result of operations of the business for a particular time period specified. That is, for a particular accounting period. Now, in this particular statement, we show all the revenues which are being earned during that particular time period. And along with all those revenues, we also have to show the expenses related to that revenue that were incurred to earn that revenue. So, all the incomes or the revenue along with the expenses have to be shown in a profit and loss account statement. Now, as we all know that when we do accounting, we have two sides. One is a debit side and another is a credit side. So, in a profit and loss account statement, that is a kind of a account. We can assume it as an account also. So, we have one side that is a credit side and then we have one side that is a debit side. So, we record all incomes related to that particular accounting period on the credit side, and then all the expenses related to that particular income are recorded on the debit side. Now, if the incomes are more than the expenses, that is, the credit side is more than the debit side, then the difference is your net profit. But if the debit side is more, that is, your expenses are more than your income or than your revenue, then it is a net loss. So, the basic purpose of preparing this profit and loss account is to find out the profits or losses. Now, why we need this profit and loss account statement? I told you that we need to prepare the statement to understand or to calculate the profits or the losses which the business has incurred due to its operations during a particular time period. That is, just to know the results of the business for one accounting period. But this statement, it also helps the business in comparing the results. That is, the profit and loss of 1 year can easily be compared with the previous year's profits or losses. Now, this comparison helps in facilitating or it facilitates in controlling the various expenses. Now, we can easily find out why the profits were more, why in one particular year the expenses are more, why there was more income, why there are more expenses, why there are more profits, why there are more losses. So we can easily find out the reasons and then we can find out how to control those expenses also. That is why we prepare this particular statement. And this profit and loss account or a statement is also called as income statement, or we can also call this profit and loss account. Now, we know that, okay, why we are preparing this profit and loss account? Because we have to calculate that whether the business has earned profits or it has suffered certain losses. Now, when we start with accounting, we learn certain concepts And at this particular time, when we are preparing a profit and loss account statement, at that particular time, there are certain concepts which we have to keep in mind, or which are very relevant when we prepare a profit and loss account statement. Now, the first particular concept which is very relevant here is the realization concept. Sometimes we also called as revenue recognition concept also. Now, this particular concept will help you to find out, to consider that when a particular revenue or income is considered to be realized in a business, what is the time at which you have to consider that yes, the revenue or the income has been earned. Why? Because the time period can be different. Now, what happens in a business? There can be different time periods when actually the transfer or the sale of goods and services take place, and the time when actually the payment is being received. So because of these difference of time, because of these more than one time period, it is very difficult to understand that when this revenue should be recognized as realized. So this particular concept help us to find out the time when we have to consider this revenue as realized. It is related to recognizing the time. What is the real time? What is the actual time when you have to consider this revenue as realized revenue or income for the organization? This recognition of revenue is not dependent on the time of receipt of cash. Why? Because when the cash is received, when income is actually being received, that is not important according to this realization concept. This concept says the time when the sale has taken place, when the sale of services, when the delivery of service has taken place, that is very important. Cash may be received in future, that is not important. So the time of receipt of cash is not important for this particular concept. So this realization concept says that the revenue should be recorded when the process of earning is complete, that is, when actually the sale takes place or the goods or services are being delivered. The customer may pay the cash or promise to pay the cash in future. So that future date of receiving the cash is not important. And revenue is recognized on the day of sale. That is, that date of sale is very important and not the date of receiving is important when we are recording income in profit and loss statement. Now let us take one example to understand this particular concept. Now, for example, there is A Limited which provides catering services, and this service was provided in the month of March on credit basis to X Limited. That is, the services will be provided in the month of March with the promise that the payment will be made on a later date. Okay, so maybe the payment will be received by A, that is the person who is delivering these services, in the month of April. So this is a credit transaction. Now, if we look at this example has two different dates. It is affecting March, that is when actually the services are being delivered, and the month of April when the payment will be made by X to A. So how this transaction has to be recorded in a profit and loss account statement? When we should record it? In the month of March or in the month of April? So the realization concept says that the date of delivering of services, the date when you have given the services, that is very important, and that is the date when you have to record the transaction, irrespective when you are going to receive the payment of that particular goods or services. So this particular concept is very important when we prepare a profit and loss account statement. Now, one more concept is there, that is related to expenses. Now, the realization concept is to find out when the revenue has to be recorded. Similarly, there is one concept that is called as matching concept, which is related to recording of expenses. Now, when you should record the expenses in a profit and loss account statement? Now, this particular concept says that you have to match. That is, whatever revenue you are recording in profit and loss account statement as per realization concept, you have to match the expenses related to that particular revenue, and you have to record those expenses along with that revenues in your profit and loss account statement. That is, whatever expenses you have incurred to produce the revenue which you are recording in your profit and loss account statement, you have to record those expenses also in your profit and loss account statement, because the expenses related to the revenue should be deducted from the revenue to find out whether you have earned profit or you have incurred certain losses. That is, the expenses have to be matched with the revenue. Only those expenses have to be recorded which are related to the revenue which you are recording. Okay, so this is a matching concept. It ensures, this particular concept ensures that the sale, that is the revenue, and the cost of goods sold, that is the expenses related to the sales, that is the expenses related to the production of those goods and services in that particular accounting period for which you are preparing a profit and loss statement are recorded. So the same product for which you are recording the sale, the expenses related to that particular product should also be recorded in your profit and loss account statement. And we know, okay, that is, expenses have to be recognized through a matching process and income has to be recorded as per the realization concept. So these two concepts we have to follow when we record incomes and expenses in our profit and loss account statement. Now, when we are using this matching concept, we have to consider certain things related to expenses also. The nature of expenses can be different. Now, some expenses which you are recording in your profit and loss account statement can be directly matched to the income. That is, you're recording the sales, and along with the sales, you have to record the cost related to that particular sale. That is, the cost related to manufacturing of those goods and services for which the sales have been made. So such kind of expenses are basically direct expenses, because we can easily find out that these are the expenses directly related to the income. Some expenses are there which are consumed when the income is earned. That is, when you are working or you are earning or when you are selling, you are using certain facilities, you are using certain expenses. It could be like you are paying for the rent, factory rent, you are paying for your insurance, you are paying your electricity bills, you are paying your telephone bills, you are paying for the salaries of your staff. So these are certain expenses which are consumed during the process of income, but you cannot directly relate it to the cost of the product which you have sold. Then we have some expenses which are basically the allocation of the value of assets which you have used during that particular time period or the accounting period. We normally called it as depreciation. That is, during the process of producing the goods or services, during the process of producing and selling the goods and services, a business or the organization uses a wide variety of assets. So many assets are being used. And because of the use of these assets, there is definitely a decrease in the value of that asset. So that particular decrease in the value of the asset is why? Because you have used those assets in your business, and that use is for producing the goods and services. So whatever value has decreased of the asset during that production process, during the production of your goods and services, should also be shown as an expense when you are writing the income in your profit and loss account statement. Then certain expenses are there which you have to write off. That is, certain incomes are there which suddenly become unrealized. That is, you made some sales on credit and now that credit sales cannot be realized and it becomes a bad debt. Your debtors become bad. So that is also a kind of loss or an expense for you. So you will have to consider that loss or an expense as a part of your profit and loss account statement, and it has to be recorded. So these are certain categories of expenses which we have to consider when we are preparing the profit and loss account statement, and we have to apply the matching concept. Now take the same example which we have taken for the realization concept. That is the same, that a company A Limited, it provided catering services to X Limited and it was on credit basis and it was in the month of March. Again, it was a credit transaction. The services were given in the month of March and the payment will be made, or the payment was made in the month of April. Now, for the matching concept says that when the income is being considered as realized in the month of March, as per the realization concept, the matching concept says that when you are recording the income in the month of March, so the expenses related to that income should also be recorded in the month of March. So you cannot say that income will be recorded in March and income will be recorded in March and you are going to record the expenses in the month of April. No. Matching concept says that whenever you are recording the income, the expenses related to that income should also be recorded during that particular time period itself. Therefore, we can say that this matching principle, it recognizes the expenses for an accounting period with the income recognized for that accounting period through the realization concept or the principle. Now, let us have one more concept, and this concept is very important when we prepare a profit and loss account statement. That is accrual concept. Now, this is the concept which is going to help you actually to prepare your profit and loss account statement for a particular time period. Now, we know that incomes have to be matched with the expenses, and we use two particular concepts, that is the realization concept and the matching concept. So this particular concept says that the revenue is recognized when it is realized, that is when the sale is complete, irrespective of the fact that when the cash is received or not. Expenses is recognized when in the period in which they help in earning the revenue, irrespective of the fact that the cash is paid or not. So this particular concept is useful in making certain adjustments, that is, there could be some difference between the income earned and income received. Similarly, it will also help you in making some adjustments in the difference between expenses recognized and the expenses paid. I think we can make it very clear with the concept of outstanding and prepaid. So, the first one, it helps in making adjustments in the difference between income earned and income received. Now, the same example which we have taken, we earned the income in the month of March, but we realized the income in the month of April. So, the accounting concept, the realization concept, that says that the income has to be considered in the month of March. That is, we have to record this income as an income of March. So the accrual concept says that yes, the income was earned in the month of March, although it was not received. So this is your accrued income, that is the income which has been accrued, the income which has been earned but not received. So accrued income concept says that yes, you have to record this income as accrued income in the month of March itself. Similarly, there can be some adjustment related to the outstanding expenses or prepaid expenses also. Salary, for example, becomes due on 31st of March. But the payment is made by the company or by the firm on 1st of April. So there are again two different dates. It becomes due That is, the salary has to be paid on 31st of March, but the payment is made in the month on the 1st of April. So two different dates are there. So the accrual concept says that although the payment is being made on 1st of April, but it becomes due. That is, the salary become outstanding on 31st of March. So the accrual concept says that yes, the salaries should be recorded as an expenditure in the books of companies on 31st March because it has become due. It has become due and it should be, although it has not been paid, then you should record it as outstanding salaries. And this is a liability for the business until and unless they do not pay that salary to their employees. So this particular concept will help you to make the adjustments for outstanding expenses, prepaid expenses, accrued incomes and unearned incomes also. Unearned incomes, that is income which you have received but you have not earned. So our concept says that whatever you have not earned, it should not be recorded because the realization concept says that earning is more important. Accrual concept says the time when you have earned, that is more important. When you have received that income, that is not important. So this is concept which will help you to make the adjustments for your outstanding, prepaid, accrued and unearned incomes. This concept says it records all the expenses and incomes which are related to the accounting period, whether actual cash is paid, received or not. So it is not important for this concept that whether the expenses have been paid or not, whether the income has been received or not. Why? Because whatever has been earned, whatever has been become due, it should be recorded for that particular time period. The receiving of payment, the receiving of cash or the payment of cash is not important for us. And the same thing, this concept asks for recording of all outstanding expenses and incomes while preparing your profit and loss account. Now, one more concept that is very important because again and again we are using the term accounting period. So what is this accounting period and why this accounting period concept is so relevant when we are preparing a profit and loss account statement? Why? We have one concept which is called as perpetual existence. That is, business and businessman, business or the owner of the business are two separate entities. That means businessman can come and go, but the business will go on. It will have a perpetual existence because it is an artificial person. Because of this perpetual existence, it becomes very difficult to find out the time or to find out when we have to calculate the profits and losses, because definitely when the profits and losses will be calculated at the end of certain time period. But we cannot wait for the winding up of the business. We cannot wait that when the business will be over, at that particular time we will find out whether the business has earned profit or it has suffered losses. No. We need to timely review, we need to find out timely that what are the profits and losses of a business so that the decisions can be taken. We can find out the deviation, we can find out the reasons why the business is not performing well so that the corrective actions can be taken. But business has a perpetual existence. It is not going to wind up. It does not have a definite lifespan. So what is to be done? Should we wait till the end of the life of the business to calculate the profit and losses or the performance of the business? It's not possible. Similarly, there are so many stakeholders which have some kind of interest in what is happening in a business. They have invested their money. They could be the shareholders, they could be the bankers, they could be the government, they could be your creditors or your suppliers. Now, these are the people who have some kind of interest in your business and they want to know periodically, timely, that what is happening in the business, what is the performance of the business. So these are certain reasons because of which we have this concept, that is the accounting period concept. This concept says that the life of the business should be divided into smaller parts. It could be 1 year, that is yearly, annual basis, and companies can even divide this lifespan on quarterly basis or on 6-month basis, depending on how they have to calculate the performance. Now, for this particular concept, what we do, we divide the whole life of the business into smaller time intervals. Now, this concept help us in applying the accrual concept also. Why? That is, accrual concept says that when something has become due or when something has become accrued, that is the time you have to apply. So what is that time period? This accounting concept will help you to find out that whether a particular income or expenditure should be recorded in which particular accounting period, whether it should be a part of previous year or it should be a part of current year or it should be a part of next year, because the life of the business is divided into smaller time intervals, so that it is very easy to find out the time of realization of revenues, and we can match it with the expenses also. And we have to find out whether something is outstanding at the end of a particular time period or not, whether something is prepaid at the end of the time period or not, whether the income is accrued or unearned or advance income at a particular time period. So time is very important when we are preparing the records. Similarly, law also requires that, yes, as per the Companies Act also, it is the requirement that the business organization should prepare and display their performances, their yearly performances. So they prepare these annual reports, they prepare the profit and loss account statement along with the balance sheet, and then they show that how the business is being performing. So it is a kind of information system, it is a kind of an information which is to be circulated to all. So it is a requirement of law also that timely basis, on accounting period basis also, the account should be prepared, the profit and loss account should be prepared, in which the results of the business should be communicated to all. So in this particular lecture, we have seen that, yes, realization concept, which is related to incomes, the matching concept, which is related to expenses. We have seen the accrual concept, which is a amalgamation of all the concepts, that how the income has to be matched with the expenses according to the matching concept, and what is the time period we have to record the expenses also, how we have to make the adjustments for the outstanding, for the prepaids, for the accruals, for the unearned, and then we are in a position to calculate the financial performance, the profitability, the earning capacity of your business. Now this information is very critical. Why? Because as I told you, so many people are interested to find out that what is happening in the business. They are the stakeholders. Government wants to know, the employees wants to know, the society wants to know. So if the application of these concepts is not done, or these are not being correctly applied in preparing the profit and loss account statement, then definitely the results will not be correct, and these inaccurate results will give wrong decisions. So because the decisions are also based on the performance, on the profit and losses of a business, so wrong calculation will lead to wrong decision. So that is why these concepts are very important when we prepare the profit and loss account statement. So I hope that these concepts which we have seen today are definitely going to help us to prepare a correct profit and loss account statement, and we are in a better position to understand that what is the reason of happening or having all these concepts in accounting. Thank you very much.